Entrepreneurs, angel investing, and venture capital. This is a rapidly expanding and evolving part of our financial markets. For many entrepreneurs, this can seem like a complex and daunting landscape. For investors, navigating a wide array of opportunities can tax even the best resourced operations. In this mini-series, Kevin Monserrat of Consilience Ventures asks, what's next for the venture capital industry? He follows the startup journey, first from the perspective of the entrepreneur, then the angel investor looking for early investment opportunities, and onto the VC funds looking to deploy larger levels of capital. Indeed, many features of the broader capital markets, such as data, analytics, and speed, will become increasingly important in this space. Kevin asks how each group is dealing with issues such as liquidity, sizing within portfolios, equity dilution, and the increasing volume of data. Each guest outlines their own experience of how they got into the business, how they've seen it develop, and what the future holds. Along the way, they provide a wealth of insights for everyone, from experienced practitioners to those who are new to the industry. In this episode, Simon Blakey, whose journey towards angel investing in the 1990s started in scientific research and property development, he discusses liquidity, portfolio diversification, and the role of the angel investor, as well as navigating the complex VC market.
It's a real pleasure. I have been following your success, I suppose, in the angel investing world for the past 7 years or so. Why don't you start by telling everyone who you are and what you do? That'd be awesome.
Fantastic. Thank you very much indeed for having me on. I'm really excited to take part in this. A bit of a background on me, which is what I always try and lead with when I have an initial chat with any entrepreneur. I'm originally a biochemist by training. Then I actually went to work at Sainsbury's and trained as a management accountant at the beginning of the 90s and helped with Sainsbury's Bank, the first supermarket bank. And after that, I went to work for Arthur Andersen as a financial services consultant. But whilst I was there, I was doing residential property development in West London and found I was actually making more money out of doing property development than I was working as a consultant. But this time it was kind of 98, 99, and it was the start of the dot-com boom Mark 1. And I thought that this sounded quite interesting, and I wanted to work with people who wanted to change the world. And I decided I didn't want to become a partner at a consulting firm. I could have always gone back to it, I'm sure. So I actually sold all my property interests, and I thought I'm going to try my hand at angel investing. And I spoke to a very wise man who said, Simon, if you're going to try something, do something full time or don't do it at all. So I thought, right, that's it. I'm going to be a full-time business angel investor, having had no experience of angel investing at all prior to that. I got myself a one-person Regis office in Hammersmith, and on the 1st of January 2000 decided that I was a full-time angel investor, not realizing that particularly at that time, nobody did angel investing full-time, and B, certainly 26, 27-year-olds at that time were I think I was about then, were certainly not angel investors. They were all in their kind of 50s and 60s and retired from industry and such like. So I then realized I had to fake it slightly. So I had a company called Avonmore Developments, and I decided I would pretend that was a fund, and I would go around talking to people. And if people thought they were talking to an analyst from a fund, they would take me seriously. If they were talking to me as angel investor, they were like, who are you? And that's how I really started. And I was very fortunate in that the second deal that I did, the first one was a robotics company that I sold successfully to GE. The second one was a software business, though. And it was in the prepay mobile phone top-up world. And I was in and out of that within 18 months. And as always, politely say that the founders never need to work again. And I made a bit of money out of it at the same time. So what started as I'll give this a go for a bit, has been now a 21 year journey for me. And I still enjoy every single moment of it. So I hope that gives a useful introduction to
It's
to my
fascinating.
background.
So you're starting from a world where, as a biochemist, it's all about testing, it's all about discipline, it's all about science, it's all about doing
Data.
things that are proven and
Yeah.
data. And then you move into a world where you basically build properties. We know everybody likes properties, everybody
Yeah.
has some property in their portfolio. And you do realize that actually, well, hang on, this is some of the less risky asset class on the market. If you get the location right, and then you're kind of going to the extreme, and you're going to probably one of the riskiest asset class in the market, which is the VC market, VC asset class.
Yeah.
And there's no data, is largely unprofessional, and of course we're going to have a discussion whether you think it's being professionalized or whether you think it remains fairly unprofessional. But then you are making those two investments. One of them is okay, one of them is doing really well, and you say, well, I'm going to do that again. What made you believe at the time that you could do it again? What did you not think that was luck, or did you think, I'm so good at this, I'm going to do that times and times again?
I don't think it was. I would love to tell you there was a great strategic vision behind it, but I think in your 20s, sometimes ignorance is bliss. And I thought that this was working, and I was enjoying doing it. I think, and we'll come on to this, I'm sure, is I had given my accounting background, I had a very disciplined view as to the amount of money that I was prepared to risk into venture capital. And I think one of the, or shall I say, angel investing rather than venture capital. And I think one of the big downfalls for a lot of angels is they go in big and they go in fast, and they don't understand the economics of having to reserve money for later rounds. There's an element about diversification as well. I'd always sat there going, well, I will try my hand at this. I am enjoying doing this. The most enjoyable thing for me is working with really bright, intelligent, passionate entrepreneurs who want to change the world. But I was very disciplined at ensuring that I wasn't overcommitting myself to that industry. So if everything went horribly wrong, I have always said I'll put my hand up and go, right, I'll go back and do something else. I freely admit I'm probably unemployable now, having done it for so many years. But I think that you have to enter this being very clear that the money you invest has to be on a personal basis, money that you can afford to lose. And if you are desperate to get liquidity out of the back of an investment, that might not drive the best result for the company, and it may make you misaligned with the entrepreneur themselves.
Oh, I love it. I mean, there's so much gold into everything you're saying. So I'm just going to try to pick a few points here. So you talked about liquidity and you talk about risks at the same time. And, we all know those traders, they're trading in the equity market, the stock market, and they know they can't take risks, but they know they can take their money kind of almost in the next second, in the next nanosecond sometimes. Yeah. So here when we're playing with risk and high risk assets and with time, how do you combine risk and time? Because that is, to me, if we were to kind of do the chemist here, it sounds like a very bad formula. It's a recipe for disaster. A long uncertainty, no liquidity, high risks, no data. What's going on in your head when do you try to be rational? Do you try to be irrational? What's going on in your head? Can you share a bit more about how you look at these things?
I always think that you have to be, as an angel investor, a realistic optimist, as I describe it. You have to be realistic that the vast majority of your deals are unlikely to succeed, but you have to be optimistic, because otherwise you will always find a million different reasons why you shouldn't do an investment. And I think sometimes the two most difficult things for an angel investor are writing that first check, because then you've actually committed. You've gone, right, I'm going to put some of my assets on the line into this high risk venture. On the back end of it, though, I think the other thing is your first failure, because I slightly describe your first failure as when you break up with your first long-term partner. You quite often are absolutely devastated. You think you're never going to recover, you're never going to love someone again, but actually then you jump back in and do it. And I think you have to be prepared to be that optimist that you will that a business will succeed, but you can't get too wrapped up in the failures, because the failures are very much the natural part of an angel investment cycle. It's not all successes. If you get those two things really worked out in your mind, you then start really looking at it going, okay, this is the proportion of my assets that I am prepared to put towards this particular angel investment class. And knowing that is, having taken those different criteria into account, I think you can afford to take a risk. I don't know whether that quite answers your question, but that just explains slight of the thought process that I go through. I say, I've got X amount of money that I want to invest in any 12-month period in initial deals. Then when you start looking forward, you're looking at the follow-on rounds. You're going, well, have they been de-risked sufficiently for me to put more money in? Do I have the money to put in? Have they been de-risked? But also you have to realize, just because a company has raised a Series A financing does not mean that it's going to become a unicorn. It does not mean that it's still, I mean, I've got companies that raise Series Bs that, haven't gone anywhere, but the risk is reduced. Is that helpful?
Yeah, no, I really love it. So for everyone who is new to angel investing, what you're saying is, if you've got, say, $500,000 to invest over the next 12 months, instead of kind of being super excited and over optimistic with one company, and then kind of put the $500,000, and own, 20% of the business in the first tranche, what you're saying, well, let's first write a check of 100K. Let's wait over the next few months how that develops, and how the risk is going to reduce, and then you are thinking, well, now I have 400K left. Either I judge that there is enough risk reduction that I can participate more, even though I lose a bit on the stake I now own, because the value has gone up. But you also have in mind the fact that you can use those 400 to make other deals of 100K. So how do you split the money in your head what's your portfolio construction strategy when you're thinking of investing in amounts? Are you looking at doing more A, B, where in very, very few deals, or are you more interested in kind of writing 5K, 50K checks into various deals? What's the approach of
I
yours?
think because I'm so far kind of down the rabbit hole, I have a portfolio already, and so I'm also looking at this from a portfolio construction on a year-by-year basis, saying, right, okay, I've exited out of this company and this company. The amount of funding that these remaining companies require is likely to be X, and part of that is driven by what co-investors I have alongside me as well. There might be some big funds with big pockets, so if I decide to put an extra 50 or 100,000 into a business, it's not going to make a huge amount of difference to the business. Yep. It's maybe just protecting my stake in the business. So I am every year adjusting that proportion towards new deals and follow-on investments. There's no right or wrong on this, but I think there are metrics around that say for every £1 you invest in an initial deal, you should save £2 or £3 for the follow-on. But it really does depend on the individual companies and the individual portfolio composition. But what you were initially saying is take a stake and then follow on in later rounds once the risk is reduced, I think is absolutely the right position to take. And actually, if you look at the global market as a whole, that's why we're currently seeing a lot of the larger funds driving down towards the earlier stage, because there is a huge difference from an investor's perspective once you're on the cap table versus
trying to get in later.
Trying to get in later. So that's why you're seeing that valuation inflation and the largest funds coming down. And it's happened before. You know, we go through cycles, and I've seen this several times before. They're basically buying an option to lead or at least participate in a later round.
Yeah, so basically you're talking about almost the scouting programs that the mega funds of the large funds are now using. Is that how can I squeeze in or sneak in very early in the deals, even though I know that it's too costly to spend the money at this point, because of course the larger the investments, the cheaper it is for me to deploy that money. And that's the conflict with the mega funds and the big funds, is that the larger you grow your fund, the more expensive it is to kind of write small checks. But at the same time, you know that writing small checks is kind of getting you a seat at the table, and also kind of basically it helps you to participate in the value creation a lot earlier than other investors that will not be able to invest in small checks, in small tranches. So you talked about something about your network, right? And do you think that's a thing? Do you think that your network is what makes you a good angel investor? Or do you think that anyone can be an angel investor? Everybody who's done, even if they are not chemist by background, if they have done a portfolio, a property portfolio, and they are thinking, look, now I have a few millions worth of properties, and I'm going to sell part of this, and I'm going to allocate this into the in angel investing. Do you think everybody can jump in, and where should they start?
I mean, the simple answer is yes, of course, anyone can be, but of course there's a lot more nuance to it, and I think the nuance is the deal sourcing in particular for it, because I'm of the strong opinion in the current market that capital is not the rate limiting factor for good companies. I think there is so much early stage capital out there that a good company should be able to raise. Now, I'll probably have a lot of people emailing me saying, I've got a great company and I haven't been able to raise. And I apologize that not everyone is capable of raising money, because there are very particular forces at play. But yes, you can. Anyone can become an angel investor. But I sit both as a VC now and as an angel, and because I advise some VC funds, and it really is accessing the deal flow. If I started off again now, I would be like, okay, I am an angel investor. How am I going to access the very, very best deals that I can, not necessarily having a network in that particular area? One route that a lot of angels now do is actually they attach themselves to accelerators, and they use their advice and expertise to help companies going through accelerator programs, which are essentially, company creation factories. And I think that's where angels can really, really have a positive impact on the ecosystem. While cash is cheap in the current market environment, experience is everything. If I am a cashed out entrepreneur and I want to go and invest in angel investing, is really valuable for a startup company. And it's equal as well. I think you've also got to look at this from the metrics of a VC. A VC cannot generally spend huge amounts of time of any one company in their portfolio. So you can your experience can be key for a startup, and equally as well, you are able to spend probably a lot more time with a entrepreneur than a VC can, given the fact that they've got to manage a whole portfolio of different businesses, as well as every 3 years or so go out and raise another fund from their limited partners. So an angel can have a great impact, but don't just think as an angel investor, I have a pot of money. This will make me a successful angel investor. There has to be more factors in play than just that.
Well, this is exactly was my next point. I think what you're talking about, it's talking about experience, and you're talking about being wise and not just someone who is writing a check. Can you talk to us a bit more about what you think the value is of an angel investor for an early stage companies? The value, and what I mean by the value, it's the role. What's the role of an investor, of an angel investor?
Sure. I'll answer that in a slightly different way, but I hope this works. I have some people coming to me and say, shall I raise angel money or shall I raise venture capital money? And I think it slightly depends on the point that you are in your business development. I think angels don't have that 10-year funding metrics that VCs have to look to at all times. Yeah. We as angels can give a company time to really work out what their business model is going to be. I have one company in my portfolio that I've invested in about 18 months ago. It's changed its business model several times, but that's absolutely fine. I invested in that knowing that what I was investing in probably wasn't the business model that was going to get them to a hyper growth stage, but I was comfortable with that because I was investing in the entrepreneurs and I thought they were really, really strong in what they were doing. VCs are under a lot more time pressure, and just given the unit economics, if you're not hitting your targets, if you're not going to be driving that IRR for the fund, if you are not on that rocket ship level of growth, which allows them to raise the next fund and gives most importantly a good return for their LPs, then you might suddenly find that the VCs aren't quite so engaged with what you are trying to do. So I think the angels can really allow an early stage entrepreneur the time to make mistakes. I think the other things, of course, are down to just deep domain expert experience. I think so many entrepreneurs are great product people, or potentially really good salespeople. What they have no experience at all is, how do you do HR? How do you recruit people at scale? Or the other thing I find strange, but I'm biased because of my accounting background, is how long people actually manage to get away with not having strong financial management in place. One of my really strong companies in my portfolio, the CEO called me up, and he's a couple of years in, after me getting very frustrated with his financial management, he said, I found someone, Simon, who is even more scary than you around finances, and I therefore recruited him as my CFO. And I thought, great, that's what you need to have. And those sorts of disciplines are things that angels don't. The entrepreneur doesn't need full-time assistance on that, but the angels has probably come across a lot of the problems they're likely to face, and therefore can give good assistance.
That's awesome. All right, we're almost at the end, Simon. I'd like to spend the last minutes or so to talk about what's the place of the technology in the world of an angel investor.
I have to. What do you mean in sourcing?
Do you use any tools? How do you source deals? How do you manage your portfolio? Are you, how do you use technology to serve you as an angel investor today? And does that even matter?
I'm a Mr. Disciplined as far as I have spreadsheets monitoring every single investment that I've ever done, making sure I've got the forms right. I have Dropbox. I even use Calendly to manage appointments and Pipedrive to manage deal flow. I don't use any specific top software tools just for VC angel investment as such.
Awesome. Well, Simon, I think we are right now at the end of the show. Thank you so much. I think it's been super insightful, and I do hope that the audience here on Real Vision will enjoy exploring more angel investing, and hopefully we'll see more angel investors participating in this exciting part of the market. Thank you very much.
Thank you very much indeed for your time, Kevin. It's been a great talking to you.
Pleasure was mine.